Alrighty, welcome everybody to today's presentation. We're going to be talking about mastering market momentum and how using momentum can help solve a whole lot of different problems. Things like false breakouts and having setups that don't work out and improve your probabilities of success while simultaneously helping to minimize your risk because the market's moving your direction much faster. My name is Thomas Wood. I'm the Director of Trading Operations and a partner here at Microquant and Basecamp Trading. So without further ado, let's go ahead and get started. Before we jump in with the good stuff though, as usual, we have to go through the risk disclaimer. Trader investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance making independent investment decisions. BasecampTrading.com is taking reasonable measures to ensure the accuracy of the information contained herein. However, BasecampTrading.com is not guaranteed its accuracy is not liable for any loss or damage which may result directly or indirectly from such content from an inability to access such information or delay in or failure of the transmission or receipt of an instruction or notification in connection therewith. Any past performance results shown for illustration example only are hypothetical and as such have many inherent limitations. No representation is being made that an account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. Then along those same lines, we're required to show you CFTC Rule 4.41. This is basically just a hypothetical disclaimer. What this is saying is if we're showing you examples from the past, obviously we are because we're taking screenshots of things that have happened previously, so I can show you examples. There's no guarantee that they're going to happen again in the future. Now that being said, I don't teach anybody any strategy that I'm not willing to put my own money on. I don't think it's right that there's educators out there that will go and trade simulated accounts and simultaneously try to tell you that you should trade your live account that way when they're not even doing it themselves. So I don't teach anything I'm not willing to trade myself. Now, with that being said, for those of you that don't know me, this is me, Thomas Wood, my beautiful wife, Dora, and our little dog, Merlin. One thing I get a lot of times is, well, Thomas, you're really young. I didn't expect that. I say, yeah, I'm relatively young. I've been trading though since I was about 13 or 14 years old. So let me give you a little bit of background information about me. I've been blessed enough to have traded live more than most people will in a lifetime. I got started in this industry. The whole reason I transferred over and started trading in the education industry and teaching people is because the person that got me started in trading was my father. Okay, and he owned a construction company and said, look, this is, if you don't want to be doing this backbreaking work like I am, this is the way to go. And he had gone out and he had looked for educators or somebody to teach him and help him and ended up losing hundreds of thousands of dollars following these quote unquote gurus out there. And I thought that, you know, that wasn't right. And I wanted to become the exception to the rule and actually help people and actually show people that, look, trading, you don't have to be a Harvard graduate or some super smart Ivy Leaguer that has a 4.0. It's not as difficult as you think, and with a proper plan, with guidance, with discipline, and with patience, you can actually be successful in this industry, which is why I'm here doing this, trying to help as many people as I possibly can learn how to trade. Now, for those of you that go, well, how come you never show your results? One of the big reasons I don't ever focus on me and my trading is because if you're coming in and you're saying, I'm looking for someone to teach me, somebody to help me learn how to trade, anybody can go up and say, well, look how great of a trader I am. But that doesn't mean that they're a good teacher. So one thing I always try to focus on, and at the end of this presentation, I'll show you a whole lot of results from my students and from people that I've worked with. And the type of results I help other people achieve. Now, that being said, this is one of my brokerage statements. This is my equity curve so far this year. It's actually a little bit further up than that now. This was a few weeks ago. But the broker statement on the left is showing a one-day gain of around 37,000. So far this year, it's been going really well. We're averaging about a 13% return each month. So I want to show you that just because, so you can see that I actually practice what I preach and do what I'm telling you I do. Now, that being said, I've got a question for you all. Where are you at currently with your trading? So you're in one of three categories typically. And those three categories are either A, losing money, B, breaking even, or C, making money. So with your personal trading, where are you right now? A, B, or C. And I guess category D would be not trading. B, A, making a little, but you want to make more. Making money, losing money, losing money, losing money. B, C, but it took 10 years to get there. Good deal, Jennifer. B, B, A, B to C, C, A, B. See, sound like I'm saying the alphabet. A, B, C. Well, let me tell you a story about a guy named Dave, and I'll show you Dave's equity curve here at the end of the presentation. But when Dave first came to Basecamp Trading, first came to us and said, join the community, he said, you know what? I've tried trading. I've gone to everybody out there. I've been around the block with educators because I've never failed at anything I've tried to succeed at. And he goes, I've studied trading more than anything else in my life. But the more I trade, the harder I try to be successful, the worse I do, and the faster I seem to lose money. How many of you can relate to that story? Where it seems like the harder you try to be successful at trading, the faster you tend to lose money with your trading. And that's a problem that a lot of traders face is, and that's the thing with trading is when you start trying to dig yourself out of a hole, which is what a lot of traders end up doing. They get into a hole and they try to dig their way out of it, and they end up losing more money faster because they keep trading more and more and more, trying to get out of it. But the one big problem we see that happening with this is causing this is they go bouncing around from this educator to that educator to this educator to that educator and all these different people, and they get so many different signals and mixed opinions on ways to trade. I'm not here to tell you any one way of trading is better than the other, but each of these ways of trading are not designed to work with the other. So one thing we always tell people is, look, when you're coming into us and you're looking to learn how to trade, you need to stick with what we're teaching you because it's not designed to work with anybody else's. So keep that in mind as we go through today. And we're going to talk about some things you can do using momentum analysis and how you can get started with momentum analysis to actually start improving your success. All right. Now, how many of you have an equity curve that looks similar to this? Where you start off pretty good and you start climbing, 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 and then it gets a little rocky, and then all of a sudden it's like you fell off the side of a cliff, and that's when you tried to dig your way out of the hole. That's you. Yeah. I'll show you. This is a guy named Sam. This is his equity curve, well, one of his equity curves that he first sent to us, and I'll show you what his equity curve looks like now at the end, just like I'll show you Dave's. And this is one of the reasons we're in the business that we're in, right? Is our mission is to help you change your long-term habits, your behavior patterns, and your futures. Now, I want to make sure I set the tone here. I'm not going to sit here and spend an hour teaching you something, and then all of a sudden, boom, you're going to be a profitable trader. It doesn't work like that, okay? It's a journey. It takes commitment. It takes time. It takes a lot of effort. But we've helped hundreds of people get there, and I'll take time on my day today and actually teach you something that I believe will help, all right? But don't expect to just come to a 1-hour seminar or webinar and all of a sudden you're going to be the world's best trader, because you can't just flip a switch and become a profitable trader. It takes time and it takes guidance, and that's what we're all about here at Basecamp, is helping people with that long-term guidance and saying step 1, step 2, step 3, step 4, and help you make adjustments along the way to get there. Okay, so what are you going to learn today? So how many of you here wish you could improve your probabilities of success when placing a trade? Improve that slight chance that I'm going to do better, that I have a higher probability of making money. Whether that be a breakout trade, a trend following trade, counter trend trade, any of the above. Everybody here better say yes, because if you don't think you can improve your probabilities of success, you're probably lying to yourself. All right. So one of the best ways, in my opinion, of improving your success rate is by adding additional filters to the market to identify the highest probability setups. And one of those filters that I prefer more than any other, I get asked this question all the time. If you could pick one indicator that you had to trade with for the rest of your life, well, 1, you don't have to, but 2, if I did, it would be momentum. I'm going to teach you about that today. So what are we going to be talking about? We're going to talk about understanding momentum trends. So understanding the trend and the momentum that a market's experiencing. We're going to talk about how to tell when a market's losing strength. So how to tell when buyers or the rallies are losing the strength that they originally had, or when the sell-offs are losing the strength that they originally had. And then lastly, we're going to talk about using divergences to identify potential reversals in markets and identify tops and bottoms. Okay. Now, again, today we're going to cover all this. This is really good information, but you got to realize that ultimately real change only comes from a long-term commitment. You don't put a Band-Aid on a sinking ship. You pull it out of the water, you fix it, and that takes time, and then you put it back in new. All right. So why do we trade momentum? Why do we look at momentum? Well, it helps solve a few different problems. Number one, it's going to help with keeping us out of false breakouts. So it's going to help improve our probabilities of when we're taking a breakout trade that market's actually going to run. Two, it's going to help keep us from getting long at the market top or short at the market bottom. How many of you get into a trade only to immediately have that market turn around and move the opposite direction? So you go, oh goodness, this market's taking off, so you get long, and then all of a sudden it turns around and starts selling right back off as soon as you got in. Or it's going through the floor and you go, oh goodness, I need to get short. And all of a sudden it turns right back around and goes the opposite direction. Well, analyzing momentum can help decrease the probability of that happening. It can also help increase our win rate. So for those of you that are going, you know what, my strategies, they tend to have a really good reward risk, but I'm not winning enough of them. Well, adding a momentum filter can help with potentially increasing your win rate because it gives you a higher probability of the market moving in your favor. It can also help increase our reward risk ratio. So if you think about it, there's two ways to increase a reward risk ratio. We can either A, increase the amount of money we make on our average winning trade, or B, decrease the amount of money that we lose or the amount of risk that we have to take on our losing trades. So if we're using momentum, one of the great things about having momentum and using momentum analysis is that it increases the probabilities that that market, once you get in, is going to move in your favor very quickly with a minimal retracement, which in turn means we can use tighter stops, and it lowers our risk, which helps increase our reward risk ratio. Okay, so it's going to help solve a whole lot of different problems that we see traders facing. Now, what markets can we actually use momentum analysis in? Which is a good market to trade? Well, you can use it in stocks, options, futures, forex. It doesn't matter. The charts all move similarly, and now each market has its own personality, but you can use the same type of analysis trading in equity that you use trading gold futures, for example, or trading the euro US dollar. And I'll show you a bunch of different markets here as examples as we go through. So let's talk about what the MQ momentum indicator is and how you read it. What we're looking at here. So this is the indicator we're going to be talking about today. This is called the MQ momentum, which stands for micro quant momentum. It's a proprietary indicator that we put together. All right. And it's set up as an oscillator. An oscillator means it goes, there's a zero line, a center line. It oscillates above and below the zero line. Okay. And that's important that you realize that, because I'll show you here in a little bit why that's important. Now, what we're looking at here, we have a few different pieces to the indicator. First off, we have our slow line, which is going to be this dotted yellow line here. All right. Now we also have our fast line, which is going to be the solid white line. Now when the fast line is below the slow line, that's going to give us bearish or red histograms. The further below that slow line the fast line is, the deeper these histograms are going to get. All right, now if the fast line crosses back above the slow line, we're going to get up histograms. The further above the slow line the fast line is, the bigger the upside histograms are going to get. Okay, now what are each of these things showing us? Well, we typically look at the indicator lines together as a pair. All right, so the indicator lines are going to help with determining the direction of the momentum trend, which we'll talk about that here in just a minute. So that's going to help us understand the overall flow of momentum. Now the histograms, they're essentially telling us how hard or how much force is behind each move the market has. So for example, this down move up here had a lot of downside strength. There's a lot of strength behind that down move. This down move here, number 2, had less strength than the first one, because the first one came way down here with our histograms. The second one came right here. The third one, this down move here, number 3, had even less downside strength, because you only got this deep with our histograms. Does that make sense? So you guys can see a lot of downside strength, a little less downside strength, not very much downside strength. And in the exact opposite way, we can see the upside strength. So initially, this move up here corresponds to this set of green histograms that had a lot of upside strength. Okay, then this rally, not nearly as much upside strength as the first one. And then this rally, even less. So we had decreasing upside strength. All right, and we'll talk about here in just a minute why that's important with understanding the strength behind the move. But the number one thing I want you to notice right now is just how to read the indicator. We're looking at indicator lines, and then the histograms. Indicator lines are showing the momentum trend. The histograms are showing the strength of each move, how much selling force or pressure was behind it. The way I like to describe it is it would be similar to saying, if this is this little red histogram right here, where you barely had any downside strength, if that's like getting pushed by somebody, this would be like getting hit by a Mack truck. There's a lot more force behind it. Okay? And then the upside is the exact opposite. If this is this upside histogram here, this upside set of histograms there, the green ones, if that's like getting pushed, this one's like getting hit by a freight train. Okay, a lot more upside strength behind it. Make sense? So now let's talk about a momentum trend. Now to understand what the indicator is telling us, let's talk about what a momentum trend is. Many times when you're trading, you're going to see a market that has a really long stretch of increasing or declining momentum. And this is what we call a momentum trend. All right, now momentum trends are identified by pivot high and pivot lows on the indicator lines. So what do I mean by that? Well, if we have the indicator lines moving like this, okay, these are each pivot points. You see how the pivot lows are higher than the last pivot lows, and the pivot highs are higher than the last pivot highs, right? So you had pivot high, pivot low, pivot high, pivot low, all the way up. All a pivot is a turning point. So in this case, that's an upward momentum trend. Momentum is climbing. We're putting in higher highs and higher lows. Now, if the indicator line is going something like this, we have a downward momentum trend. Okay? Going lower and lower highs and lower lows. So that's kind of oversimplifying it, but I want you to get an idea of what we're looking for when we're looking at these indicator lines and looking for the momentum trend. So here's an example of a bullish momentum trend. All right? We look at the indicator line. You can see how we have strengthening, higher highs, higher lows here. All right, now again, we're looking at kind of the two indicator lines as a whole. Okay, so our upside momentum, higher highs, higher lows on the slow line and the fast line as this climbs. Everybody see that? And then right here, we start to change because our slow line starts getting a little bit weaker, then pulls back up. Now, when we're analyzing momentum, we don't ever want to just blindly look at a momentum chart. And this is why. We don't want to just blindly look at the indicator and ignore what the price action is telling us. We always want to analyze price action and momentum. So remember how I told you that the momentum indicator is an oscillator. So it goes above and below a zero line. You always need to confirm the setups with the price action. Now, how do we do that? We need to see if momentum is weakening. We need to see a break of a pivot low. If momentum is strengthening, we need to see a break of a pivot high on the price chart. Why is that? Because if momentum gets pulled really far away from zero, like we do right here, and price moves sideways, like we do right here, because the nature of an oscillator and how it's coded, it's going to start pulling back to zero. That does not mean that that's bearish momentum necessarily. it has to have bearish price action to agree with that. Okay? Make sense? Just like down here, we got really far away from the zero line, but how did the price action confirm? Well, price action confirmed because we started putting in higher highs and higher lows on the price chart. You see the difference? So down here, price action confirmed that this was actually bullish momentum and not just a retracement back to the zero level on the momentum oscillator. Up here, price action did not confirm. All right, so let's take a look at a bearish momentum trend. Whereas a bullish one is putting in higher highs and higher lows, a bearish one is putting in lower highs, lower lows. So in this case, we went from strengthening upside, and then we started getting weaker, and then weaker, and weaker, and weaker. Now, once again, in this case here, you see how we started to weaken with momentum. Here's your first quiz. Did price action confirm that weakening momentum? Good job. You guys are a smart bunch. No, it didn't confirm the weakening momentum. Why didn't it confirm? Because price chart continued to put in pivot highs and higher lows. Now, if we look over here and we see the weakening momentum, did price action confirm the weakening momentum over here? You got it. How did price action confirm? Because we broke through a previous pivot low, broke through this pivot low right here, put in a lower pivot high, and changed price action trend to lower highs, lower lows. Now this is a setup that one of the members, or actually a few of the members, this was on Friday. This was in bonds on Friday on a 500 tick chart. When we had that spike first thing in the morning, there you go. And then momentum and trend changed, and right back down we came. Great setup. Okay, but is that really understanding how the momentum trend changed here? And then we had bearish momentum, and we stayed bearish momentum moving lower this entire down move, this entire downswing. Making sense? Excellent. So let's talk about, now that you understand how to read what the indicator is telling you, and you understand how to read the indicator lines and look at the momentum trend, let's talk about how we can combine this with the price action to find potential tops and bottoms in the market using divergences. Okay, now divergence occurs when the price and indicator are no longer correlated, no longer moving with each other. So normally when we're looking at price chart that's going like this, we want to see the momentum with an uptrend and with the upside histogram strengthening as it goes higher. Sometimes what will happen though is price action will continue to go up and momentum will start to weaken. And when that happens, price action hits a new high, but momentum stays lower. That's what's called a divergence, and it's going to be weakening. Now, we don't just look at one part of the NQ momentum. We're not just looking at the indicator lines. We're looking at both indicator lines and histograms. All right, and we're looking at one set of up histograms and upward indicator line compared to another set of up histograms and indicator line, or down histograms and down indicator line. Okay? So there can be both bullish and bearish divergences. A bullish divergence occurs when prices are equal to or go lower than the previous pivot low while the indicator stays higher. Okay? A bearish divergence occurs when prices are equal to or go higher than the previous price highs while the indicator goes lower. Now, what's a divergence telling us? One big mistake that a lot of traders make is just because you have a divergence does not mean the market's going to reverse trend. Okay, we cannot look at a divergence and operate on the assumption, okay, this trend is over, it's going to start going down now. Remember, price action always needs to confirm momentum. Divergences do show us when a market is trying to push to new highs or lows without the momentum that the original move had. So when a divergence occurs, we can say we have a higher probability of this market pulling back and going into consolidation than we do of it continuing. Okay? And then if we get a change in price trend, the price action confirms the divergence and the momentum trend change, then we can look for a bigger move. Okay, so basically what we're looking at when we see a divergence is we're seeing like the last hurrah that a market makes before either taking a breather, slowing down a little bit, or potentially reversing. So what does a divergence look like? Well, this is Tesla. This is a daily Tesla, weekly, or over the past couple of weeks here. So what are we looking at when we're looking at divergence? You look at 2 pivot highs, okay? So here's pivot high number 1 on price. Here's pivot high number 2. Everybody see that? Number 1's right here. Number 2 is right here. Now let's go down and look at the momentum. So pivot high number 1 corresponds to this entire set of green histograms, okay? And to the highest point on the indicator lines there. Pivot high number 2 corresponds to this set of green histograms and the indicator line there. Now looking at this, do you guys see how even though pivot high number 2 went to higher high prices, the indicator line weakened and the histograms significantly weakened? All right. Now again, you're always looking at 2 sets. Pivot high 1, pivot high 2. Set number 1, set number 2. And you're looking at the difference between the two. If the market was going to continue to go higher, we should have seen continued strengthening of momentum. If it was going to pull back like it did, we should have seen weakening momentum like we did. Now, how did price action confirm this move down? Well, we confirmed the move down when we break through this pivot low right here. Once we broke through that low, so as of that day right there, then we're going check, look for the bigger retracement, which you got here, and momentum confirmed. Make sense? Same thing happened over here. Okay, so we had pivot high number 1 and pivot high number 2 and pivot high number 3. Okay, number 1, number 2, number 3. Now, look at this. Indicator line, weakening, check. However, histograms, strengthening. Downside, strength was weakening. Also, price action doesn't confirm. Over here, from number 2 to number 3, we still have weakening indicator line and we have weakening histograms and downside strength strengthening. However, what did it need to do to confirm? Would have needed to come all the way down and break through the pivot low. So yes, we got the consolidation. No, we did not trigger the bigger move in the opposite direction. Does that make sense? Everybody understanding that? So we went into consolidation. We did not trigger the bigger move in the opposite direction like we did up on the second divergence up here, or we did trigger the bigger move in the opposite direction by not only consolidating, but breaking through the pivot low. So price action confirmed it. Okay, let's take a look at another example. This is crude oil on 240-minute chart. So that was a bearish divergence. Now let's look at a bullish divergence. Okay, so we're going to look at pivot low number 1, pivot low number 2, just about equally low lows. However, look at the difference. So we're going to look at this entire set of downside histograms compared to the second set, which would have been right here. There was not a second set. So this is what we call a no return divergence because the histograms could not even return back to bearish. Look at the indicator line, the strengthening between the 2 lows. How does it confirm? Breaks through a previous pivot high. When it breaks through a previous pivot high, we then look for the bigger move up. Retracement, bigger move up. So price action confirmed once again. You guys see where I'm getting at with this? Now look over on the left-hand side of the chart. Pivot high 1, pivot high 2. Pivot high 1, pivot high 2. See the weakening of the momentum? See how we went from strong upside histograms to weak upside histogram. So there was basically no strength behind that second rally right there. Where's the pivot low? There you go. That's when it confirmed the breakdown, and you got your bigger move lower. Everybody following along? So that's how we look at price action and momentum indicator and histograms to confirm. For a divergence, this is how you identify potential tops and bottoms. Can you say, is this momentum indicator the same as an MACD? No. MACD and MQ momentum are both oscillators, but they have completely different math going into the calculations. So they're both momentum oscillators, but that's about it. All right, so let's talk about another way of using it, of using momentum. Another one of my favorite ways of trading momentum is looking for a breakout and looking for the momentum to confirm a breakout. Okay. Another great way of using momentum analysis is by identifying high probability breakout patterns where the momentum agrees with the direction of the breakout. Now, if you follow our YouTube channel, I post videos about this all the time, and breakout patterns that happened with price action, and we always look down and say, okay, look at how the momentum confirmed this breakout. Look how you get strengthening upside leading into a bullish breakout, or strengthening downside leading into a bearish breakout. So if you want more examples of that, just go to the YouTube channel, but I'll show you a few here right now. So what we'll look at, this is gold. This just happened the other day as well. Gold was inside of a pennant pattern. How do we know it was a pennant pattern? Because we had narrowing range. Pure highs and lows were narrowing. If you are a member of Basecamp Trading, we talked about this pattern in the end of day video right there, saying watch for the breakout the following day. This was Thursday night's video, Friday, boom. Okay, now let's look at the momentum leading into this breakout. So right here is where we break out. Which direction is momentum going into that breakout? Standalone, Raphael. Yep. So which way is the momentum leading to that breakout? Very obvious bullish strengthening momentum. So what's that mean? It means we have a much higher probability of getting that immediate follow through from the breakout, just like we did here. How do we know it was strengthening momentum? Well, upside strength went from decreasing upside strength. The upside swing has got weaker and weaker and weaker, to upside strength was getting significantly stronger. Indicator line went from bearish momentum trend to bullish momentum trend, all before it actually broke out, and it broke out right at this point here. Wish I could draw a straight line. Okay, so you guys see how we're taking momentum to confirm that that has a higher that it's a higher probability breakout. And what is using momentum doing? What's this doing for us? Well, it's going to do a couple of things. Again, it means that once it does break out, we expect that market to run much faster. So within 3 or 4 price bars, we should be jumping in the direction of the breakout. Also, it helps with increasing the probabilities of success because we have momentum in our favor as opposed to going against the strength of the market or against the momentum. So the probabilities of a false breakout are lower. We have a higher chance of having a good breakout and good follow through as opposed to having a breakout and then reversal. What do you mean, what was the problem with the first attempt to break out? You talking about this right here? When you trade a breakout, where's your stop go? Your stop goes below the previous bar's low. So if you're going long here, your stop goes below the previous bar's low. Now in this case, that's a pretty big stop. That being said, right afterward, this is what's called a bull flag setup. Okay, and if you're trading a bull flag, that means you're getting long right there. Your stop just below the flag. Additionally, what we always do in the trading room is you'll see us go through and we drill down. We go from a big time frame and we identify the strength of the market and the direction the momentum's going. Then we drill down to a small time frame and time our entry. That way you can get away with a lot of times a 5 or 10 tick stop. Very tight stop loss. You're talking about right here, Trevor? What was wrong with that breakout? There was no breakout there. If you pull back and you look at a 240-minute, 120-minute price chart, there was a trend line that was coming up and across down here, and it never broke through that trend line. Talking about right there? Again, there was no breakout right there. It hadn't set up a pennant pattern yet. So again, what you're doing is you look at the price action for the setup, you're looking at the price action to identify the compression and the consolidation for the breakout setup, and then you look at the momentum to confirm the breakout. Here's another one that's happened just here recently in the past week or so. This is price line on a daily. Price line, you have a really well-defined trend line connecting 3 different price points. Number 1, number 2, number 3, 3 pivot points. Now look at this breakout. Very nice breakout, very nice follow through. Look at the momentum leading into the breakout. Initially, we had decreasing momentum. Upside strength was weakening. Well, then leading into that bullish breakout, downside strength started to weaken as well. And then when we did break out, upside strength, momentum trend had changed. We put in a higher pivot low on our indicator line. And we're breaking to a higher pivot high as well to confirm a bullish momentum trend leading to a bullish breakout. You see how that works? So once again, momentum confirmed that it was a bullish breakout. Now, I'm not sitting here telling you that momentum is always going to confirm the direction of a breakout. It does not happen that way. You can have breakouts without having momentum confirmation, and they will follow through a lot of times without momentum confirmation. However, what we're doing is we're looking to, because trading is a probabilities game, we're looking to increase our probabilities of success in whichever way we can. One of the ways we can do that is by looking for these high quality setups that have a higher probability of success, i.e. momentum and agreeing on the direction. All right. Now look right back here as well, by the way. Pivot high 1, pivot high 2. Based on what we talked about a minute ago, what's that telling you? Bearish divergence. What would it have to do to confirm a bigger move down? Would have had to break through that pivot low, which it did not do. Instead, it just consolidated and then resumed the uptrend. All right, let's take a look at another example here with a momentum confirmed breakout. This is in bonds. This is from the big down move we had in bonds here recently. All right, look at A, the very top of bonds here. Here's your 2 pivot highs. You see the bearish divergence there, weakening momentum indicator line, weakening momentum histograms, equally high prices. So a bearish divergence, here's the pivot low, which it broke through and confirmed, but directly below that we had a really well-defined support level. So we bounced off it 2 different times at the exact same price. So well-defined support. Now look at the momentum leading into that support break. What's the momentum telling us going into that support break? Very bearish. Upside strength had weakened. Downside strength had increased. So sellers were having more force behind their moves. Buyers were losing the strength. Confirms a breakout. Trend changes to a downtrend, and you continue to sell off all the way down. So therefore, you forego some breakout opportunities in order to increase the probabilities of a successful trade by having momentum confirm the breakout move. Is that correct? 100%, Bruce. I'll pass up a lot of different breakout opportunities if momentum doesn't confirm. Is everybody understanding, though? By seeing this, does this help you kind of get a better understanding of how you can read momentum, and how using momentum filter can actually help with increasing the probabilities of success, whether you're a breakout trader, a counter trend trader, or a trend trader? And this is why I always tell people, look, if you're tired of getting into a trade only to have that market turn right against you immediately, or get into a trade on a breakout only to have it turn around and be a false breakout. If you're tired of that happening, one of the number 1 tools you can use to increase your probabilities of success is adding momentum. And that's why when people ask me, well, what's the number 1 indicator you would recommend using if you could only pick one? Momentum. And one thing that we see a lot of traders doing is they're going to go get 50 different indicators, and in my opinion, you have so many different indicators on there you can't really see the chart, you can't see the price action. Always remember that you need to keep your charts clean enough that you can actually see what the price action itself is doing, and not just, oh, let's see 50 different indicators, and the indicators are saying this, and then just blindly jump into the market. always, always, always confirm price action. That's why the number one thing I teach people is naked trading and how to read the fundamentals of price charts. Okay, so let me show you some of the results. Like I said, I don't like focusing on how well I do. I like focusing on how well the people I work with do, because that's what I'm the most proud of. It makes me more proud to say I've helped hundreds of people go and turn their trading around. That's why I like showing off their stuff. So this is Sam. Remember I showed you his equity curve earlier of him blowing up an account? These are two of his equity curves now. This is his FOREX account. And this is his futures account. He's doing really, really well. His trades have been, last I heard, he's been doing extremely well. This is the last update he gave me. Here's another example. This is from Andres. Now, each one of these traders, they all trade differently. They each trade using different strategies, but they all come back to using the same fundamental principles that we teach. And one of the big things that they're using is momentum. Momentum and price action. So in this case, he's mainly trading pairs, but he also does directional plays, using hedge directional plays, using pairs. His equity curves look beautiful. This is from Lori. It's not just Sam. It's not just Andres. This is Lori's equity curve. She does momentum directional plays. She's not doing pairs. And her equity curve is one of the best equity curves I've ever seen. I mean, it looks excellent. This is Frederick's equity curve he just sent me a couple weeks ago. And he's trading similarly to Andres with intermediate term pairs trades and directional plays with hedges using futures. Now, remember I also told you about Dave and told you about Dave Glissmeyer and how he had come in and he was a losing trader, and it seemed like the harder he tried, the worse he did at trading. Well, this was his equity curve, and he actually got to the point. He took a $10,000 account. He started off with a $10,000 account, and within a year, within 9 months, he got into six figures, and by the 12-month mark, he was averaging $3,000 a week average profits, and he was trading full-time. That's what he was doing for a living. That's how he made his money and paid his bills. And the number one thing he used was momentum. He's a momentum trader through and through. And this is why I always tell people, look, momentum is one of the most important things, one of the best things you can do to help out your trading. So for those of you that are interested in getting the MQ Momentum Indicator, this is what we're doing for you today. We actually have a really good deal. Normally it's $4.97. But what we're going to do for you, we're not only going to give you the indicator, we're also going to give you a live webinar on July 26th at 4 p.m. that I'll be doing. It'll be recorded, and I'll be going into more detail on how you actually trade using momentum, more secrets and ways of using momentum, more than what we've covered today, because today's a pretty short presentation. We're going to also include the Acclimation Workshop. Acclimation is going to give you a really strong foundation to build on. It's going to teach you fundamentals of price action, reading price action, because again, you got to confirm everything with price action. That's why I want to make sure we added this into this bundle. It also is going to give you things like how to control your emotions, how to stay in a trade, how to manage a trade. It's going to teach you how to put together a trading plan and a trading log. All right. We're also going to give you all of those things, which normally would be about $900. Today only is $297. So for the next hour, we're making this bundle available. All you have to do is go to bctnow.com/momentum or /M momentum. So what platforms is the indicator available on? Indicator is on TradeStation, it's on NinjaTrader, it's on Sierra Charts, Thinkorswim, Multicharts, eSignal. Okay, TradeStation, Ninja, Sierra, which is Infinity, TOS, Thinkorswim, Multicharts, eSignal. It's also on Bloomberg, I believe, for those of you that are using Bloomberg Terminal. Again, all you got to do is go to bctnow.com/mom. Now, I'll answer some questions. There's the link. Once you go to that link, it'll bring you to this page right here, MQ Momentum Indicator. What you're going to get, Momentum Indicator, live training session, and the Acclimation course. All you got to do is put in all your information, first name, last name, email, billing, etc. Print credit card info, complete my purchase. You can also go down here and read some testimonials if you want. There's a whole lot more on the website. But again, bctnow.com/mom. Now let me answer some questions here. Raphael, you said, I think one of the hardest things to do is stay in a trade. Is there a way to use a momentum indicator to keep you in a trade? Momentum indicators sometimes make you think the trend is about to change direction. Yeah, Raphael, you can stay in it until momentum and price confirm that the trade is no longer valid. So you can stay in it until you get a divergence and you trail your stop up behind it as momentum starts to weaken. Or you can stay in it as long as momentum trend continues. That type of thing. Does it work on Infinity? Yep, works on Infinity. Can be used on Sierra? Yes. Is it for futures? Yes, it's for futures, options, equities, Forex, all the above. I've traded all the above with it. Does it work on Sierra? Yes. Is this session recorded? Yes. I'll be putting it up on YouTube. It's on NinjaTrader 7 and 8, Raphael, I believe. Can I bring up the available platforms again? Sure. It's on TradeStation, NinjaTrader, Sierra, Thinkorswim, Toss, Multicharts, eSignal. No problem, Jennifer. Totally understand. Do you use MQ trend dots to help you stay in trend? You can, John. Absolutely. You can use MQ trend to stay in as long as the trend continues. That's a totally different indicator, not looking at momentum. So again, thank you guys all for coming out. I hope this helped you learn a little bit more about how you use the MQ momentum, how you analyze momentum to help increase your probabilities. Yes, it's a proprietary indicator, John. The workshop, for those of you that are signing up, is going to be July 26th at 4 p.m. Eastern. You're getting the indicator, the workshop, and the acclimation workshop, which is pre-recorded. The workshop will be recorded if you cannot make it there at 4 p.m. Again, all you got to do is go to bctnow.com/mom. The price is available for the next hour. Again, bctnow.com/mom. $297 for everything. Okay? So I want to thank you all for coming out. I will see you in the room bright and early tomorrow morning. Have a great rest of your weekend. And until next time, happy trading, everyone.